It is the 11th hour. The rest of the city has gone dark, but inside this department, the workday is far from over. Right now, finance teams are racing against the clock. They must capture every last invoice, vendor payment, and journal entry, locking them into the exact correct financial year before midnight strikes. A single misplaced entry can warp a multinational corporation's financial statements, leading to severe compliance failures and audited penalties. The only way SAP S/4HANA consistently routes millions of transactions to their proper timeframe under this kind of pressure is through a specific invisible framework, the Fiscal Year Variant. For a standard domestic technology firm, business operates on a predictable 12-month calendar, starting in January and closing out in December. This map illustrates how that timeline breaks down internationally. While the US runs on a standard calendar, Indian corporations run their financial year from April to March. Universities often track their cycles from August to July. A rigidly coded global software system like SAP S/4HANA cannot assume which clock a business follows. Organizations must explicitly define their localized reality. Time is a universal constant, but financial reporting requirements vary by region. The fiscal year variant exists to mathematically translate these local calendars directly into the system's architecture. Building this architecture in SAP follows a strict three-step principle: define the framework, configure the rules, and assign the business objects. Think of a streaming platform creating a new subscription tier. Engineers have to build the code and configure the pricing rules before they can assign any actual customers to the plan. Applying this logic to the calendar, this continuous stretch of time is divided into 12 discrete segments. These standardized system buckets are called posting periods. They act as the primary destination for all regular daily business transactions. As incoming financial data hits the system, SAP automatically sorts each record into the correct bucket based on the transaction date. Posting periods detach SAP from relying on a physical wall calendar. This structure allows massive volumes of business transactions to be processed strictly by mathematical rules. Let us return to December 31st. It is late, and an auditor has just uncovered a massive unposted asset depreciation. The standard December books are technically locked for normal operations. Recording this missing data into the standard periods now would compromise the finalized reports. To handle this, SAP includes a built-in failsafe, special periods, specifically designated as periods 13 through 16. These dedicated periods allow the finance team to process the late depreciation correction securely, completely bypassing the standard 12 buckets. Measured, resolving tone. Special periods act as exclusive safe spaces for year-end closing adjustments. They protect the integrity of standard business operations from post-close tampering. The system also handles complex accounting anomalies. A prime example is the non-calendar fiscal year, common in enterprises running an April to March cycle. This setup creates an immediate issue for January. It belongs to a brand new calendar year, but for accounting purposes, it must be reported backward into the previous financial year. SAP solves this with a year shift. It is a mathematical modifier that instructs the system to route those January transactions backward across the calendar boundary. A second anomaly is the shortened fiscal year. This occurs during abrupt business transitions, such as a corporate acquisition that forces a company to close its books months early. Whether a year shifts across calendar boundaries or is cut short, the variant architecture ensures global reporting continuity remains unbroken. Looking at the SAP implementation guide, this is the exact configuration path used to establish these time rules. The process begins by selecting the node to maintain the fiscal year variant. This screen shows the creation of a standard variant. For variant 31, notice the explicit division between the 12 posting periods and the dedicated 4 special periods. Building rules is only the first step. The variant must then be linked to a corporate entity by assigning a company code. Here, company code GR01 is formally mapped to fiscal year variant 31, permanently binding theoretical rules to real-world corporate data. This final configuration screen demonstrates how granular control is achieved. The -1 year shift value entered for the third month codes the system to handle backward shifting periods automatically. These specific configuration screens are the literal translation of a company's specific fiscal requirements into executable machine logic. Back in the finance department, the morning sun is coming up. the late adjustments have been securely posted, and the year-end close is finalized. Every organization measures time differently, driven by geography, local regulations, and specific industry cycles. Because of the fiscal year variant, SAP can adapt to any regulatory timeline, ensuring that every transaction across the global ledger lands exactly where it belongs.